This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Hello and welcome to Bazaar Morning Call, live from the CNBC-TV18 Motilal Oswal studio. I am Reema Tendulkar, with me, Nigel and Mangalam. Guys, so 4 Qs, right? Global markets, IT earnings, it's a Friday, and India-Pakistan. So which one are you most excited about? What's the big
tomorrow? Today, I'm most excited for it being a Friday, and because yesterday we were talking about how the prices have been coming down, I managed to secure 1 ticket.
So do you want to tell us how much you paid for it?
Well, it's a slight premium to the MRP, but definitely a lot lesser than what it was a week ago. So I managed to do that. You know, getting a match ticket is easy. The train ticket was the toughest one. So let's see how I go. If you see me dancing on top of a train to Chaya Chaya, maybe it's me traveling ticketless.
Don't forget to take that video then.
Yeah, absolutely. I mean, it's going to be
a cracking match, man.
Cracker. I mean,
I just hope that we win. That's all. That's all that matters.
We're going to be watching the match and see. We're trying to spot you in the audience, you know. So just give us cues what you're wearing, what banner you're holding. So we'll be looking out for you.
Not a banner, the India shirt for sure, but it's okay. I mean,
but we got plenty of action to track in terms of markets.
Indeed, absolutely. So let's start with the first one. GIFT Nifty is currently down close to about 150 points. There are 2 factors weighing on the GIFT Nifty. One, the US markets, the Dow, the S&P 500, NASDAQ, all ending with cuts of close to about 0.5%. The problem is the US CPI inflation print came in hotter than what the street was anticipating, a jump of 0.4% on a month-on-month basis and 3.7% on a year-on-year basis. This was more than what the street was anticipating. US markets cracked. The US 10-year yield rose to levels of 4.68. So that's reason number one. And secondly, the IT earnings, which came post-market hours, Infosys and HCL Tech, both of them were weaker than what the street was anticipating. Just as a reference, pull up the ADR. Infosys ADR down more than 6-7%. Wipro didn't come out with their numbers, but you get the sense of the sentiment from Wipro's ADR performance. Wipro ADR was down 3.5%. And the problem is both these companies have cut their guidance for the full year. And it's very unusual, right, for a company like Infosys to cut the guidance for the second consecutive time. They started the year with 4 to 7. They brought it down to 1 to 3.5%. And it's further lowered to 1 to 2.5%. So it's very unusual. And I think that spooked the street a bit about the fact that growth recovery expectations have been pushed out even further.
All right, the way I'm looking at it is the bulls, they're going to be betting on HDFC Bank because that's been, the strong point for the last 2 sessions at least. While the bears, they're going to be counting on the tech stocks itself. So that's the way, I see it. And domestic economic data actually was quite encouraging. You had inflation that cooled off a little bit. You had the productivity numbers that looked quite good. So domestic cues are quite good in terms of economic data. Well, the global Q is again in a bit of a tizzy, in a bit of a flux. You have those, the inflation number in the United States that went up. Yields as well were up more than 10 basis points on. But let's focus on the domestic Qs. And the reason I'm saying that HDFC Bank holds the key for the bulls is because yesterday we didn't move too much. And the IT index was under some pressure. So if you pull up a split screen, you'll just look at that. HDFC Bank ends at the high point of the day. The IT index ends at the low point of the day. Let's pull up a couple of weightages then. The tech stocks, they account for around 13.5% weightage. I'm talking about all of them put together. TCS, Infosys, Tech Mahindra, Wipro, all of them are put together. While you have HDFC Bank single-handedly that has close to around 13.5%. HDFC Bank and Reliance Industries together are nearly around 24%. So if both of them can hold one end up, then they can, save us from this downtick that we're likely to see on all these IT names. And HDFC Bank is approaching very, very crucial technical levels. So the 20, the 50, the 100, the 200 AMA, that's what lies ahead. For yesterday, it closed closer to around 1,550 odd, bouncing off the recent low of closer to around 1,500. What did the FIs do yesterday? Well, they covered some shorts yet again. So yesterday, there were close to 5,000 contracts that were covered out on the short side. And now in the last few sessions, from a peak of around 92,000 short contracts, we have come down to around 70,000 short contracts, which explains why we've seen a bit of a bounce. The options data, 19,800 call, well, that was getting written yesterday. It had close to around 30 lakh shares that saw open interest build up. But on the downside, there were 20 lakh shares that were getting added at around the 19,700 odd mark. So since we did see some bit of writing out there, you have the 19,640 mark, which will be a crucial support zone. The near-term number you're looking at is, the 20 DMA, which comes in around 90,715, and resistance will be closer to around the recent high. But the Nifty Bank, that holds key, and if HDFC Bank performs, then that's going to help the Nifty Bank get back towards that congestion zone. Earlier this week, it went to around 44,700, and from there, it did see some bit of a pullback. So the important levels, you wanted to get past the 50 DMA, the 100 DMA, and then move gradually towards the 20 DMA. So you'll be betting on HDFC Bank if you're a bull, and you'll be saying if this market is still in an uptrend, you look to buy the dip yet again, and in fact, try to play it from there.
Buy the dip, Nigel. That's been the texture of this market itself. And today that will be tested mainly because of the way the global markets have performed. At the same time, the Infosys ADR has performed as well. What was interesting, however, was yesterday in the dying minutes of trade, we saw the market come off a tad. And that was led lower by one, the IT index, and second, the inability of the Nifty Bank to cross that, 20, 50, 100-day moving average sort of congestion zone that we're talking about. Will be very interesting to see what happens to Infosys today. Why do I say that? Because one, GIFT Nifty is down about 150 odd points. Everyone will be looking at the IT stocks as a barometer of what happens in the globe. And we all know what happened yesterday with regards to the US CPI, right? Coming in at 0.4%, mildly higher versus estimates month on month, and both year on year as well at 3.7% versus an estimate of 3.6%. Now, had this been in line itself as well, would that mean everyone starts talking dovish? Perhaps not, mainly because inflation is persistent. It's not coming down. Had this been a big positive surprise, then all those dovish comments that the Fed officials had made earlier would perhaps be in line with the inflation data. But now, after this number coming in, yesterday the US 10-year yield increased by about 11 points. In just the last two trading sessions, the reason for the markets to rally was the US yields coming down by 15 points. So one data point comes in and, nearly 66, 67% of that decline has been priced in. The dollar index is also above that 106, closer to 106.5. Yesterday it was below 106. So those are a couple of factors I will be watching out for, and that leads to the big question. Will the Street now start to firmly price in another hike? Because up until now, there was a possibility that there could be another hike. But now, if it starts to firmly price another hike, then we'll have to see what the global market does, and the concomitant impact of that would be on the Nifty. Extremely short term, we'll be looking at the 50-day moving average on the Nifty, 19,607. And Infosys, the reason why I talk about that is one, saw a lot of short positions being added yesterday. So at some point, will those shorts cover their positions? It was 2% ahead of numbers lower in yesterday's trading session. And from an F&O standpoint, the 1400 put has the maximum open interest, and it has a premium of close to around 22 odd rupees. So will the Street look at good numbers coming in from Infosys, or will they worry about the guidance being cut by Infosys? Is something we'll have to watch out for. 1380 will be an important mark to watch.
Well, it's going to be a big cricketing week, Mangalam. So, the way I'd like to put it is your top order, the opening batsmen will be Reliance Industries and HDFC Bank. Hoping that they fire, because the middle order is looking a little bit dicey. That's all the IT stocks, because they may not, and then hopefully the tail wags at the end.
Yeah. So in that itself, the top order is playing well. We know that. The thing is, can the middle order find its form?
Yeah.
It's been going through a lean patch. If Infosys comes and hits a few sixes here and there, or maybe sees a little bit of recovery from the lows.
Sixes, I don't think so, but maybe a couple of
runs. A couple of twos.
I think Rima Singh, they're getting into my space now. But the short point I'd like to make is IT has been the place to hide.
Yes.
Yeah.
So, the last couple of days we have seen selling on IT. So from the day's low, will we see a bit of a bounce? Well, we'll know later on in the session. But for the time being, before we move on, let's tell you what's lined up on the show for the first hour today. We'll get you updates coming in from markets across the globe, and Dean Kim or William O'Neill will be joining to discuss the entire global setup. Later on, our research team will bring us CNBC-TV18's top 10 stocks for the day, and at around 9:30 a.m., we'll be joined by Nishal Maheshwari, who will be joining in to help us out with some fundamental analysis on all the stocks that we have lined up.
On the equities, Christopher Wood of Jefferies says, in terms of the current portfolio positioning in India, dedicated emerging market investors remain very geared to the consumption story. Whereas the view of Greed and Fear Index is that they should be more positioned for now on the commencing private sector capex cycle. Indian market is still at risk of more of a near-term correction. This means investors should be looking to add to property, banks and industrial stocks in any pullback in prices. Greed and Fear Index already has 56% of the Indian long-only portfolio allocated to these three sectors.
Right, let's get you some money market calls now. We have views coming in from Lakshmanan V of Federal Bank. He says that higher than anticipated US CPI led to a sell-off in the US 10-year yield, assisting the dollar index to recoup its losses from a 2-week low. This is likely to overshadow the 3-month low that the India CPI print and may put further pressure on the rupee itself. He expects the rupee to trade in a range of 83 to near 83.5 for the next few trading sessions.
Well, and on the bonds, Lakshmanan of Federal Bank says that bond yields remained under pressure in the recent sessions, rising to 6-month high levels of around 7.4%. This has the market discounted the OMO sale possibility, strong economic data from the US, which may keep the US Treasuries elevated. And this pressure could result in domestic yields as well coming down a little bit. He expects the 10-year benchmark bond yield to trade in that range of around 7.25 to around 7.35% range in the coming sessions.
Okay, let's focus then on the big macro cue coming in from the United States. Last month, consumer prices rose 0.4% month-on-month and 3.7% on a year-on-year basis, a tad higher than street expectation. CNBC's Steve Leisman breaks down the details of the September CPI report and what it means for rates going forward.
The headline CPI coming in at 0.4. It's down from the 0.6 last month, but it had been expected at 0.3. And the year-over-year 3.7 unchanged. There was hope for improvement there. The core coming in exactly as expected, up 0.3, same as last month. And the year-over-year making some progress that might be keeping people at bay, or at least putting two sides to the trade here. Gas prices went up a healthy 2.1%, and home ownership costs rose an unexpected 0.6. Most forecasts were hoping for some progress in that number. They do see it coming down in the months ahead. But there were declines in used car prices and apparel, while food inflation, it was modest this month, at least this month anyway. All of that leading to a higher probability of a Fed rate hike, but not overwhelmingly so. I was kind of surprised. It was down very low, below 10% probability for November. Now it's up to 12, and December's 36, up from 28. When it starts to get near 50, the market really means business. Officials have talked a lot in recent days of letting the higher bond market yields do the Fed's work for it, and yields are higher. So the Fed, at this point, is thought to have pivoted to hold, but it's going to keep a wary eye on inflation data. And as you know, guys, the question now increasingly is how long at these levels, not necessarily how high anymore.
All right, how long and not how high is the question with regards to the U.S. inflation. So let's take this point forward itself, and in light of that, what does it do with their investment portfolio? Dean Kim, head of Global Research Product at William O'Neill, joins in now. Dean, good morning. Just wanted your thoughts on, the question that was posed by Steve. How long and not how high the inflation, and what happens to the Fed from here?
Yeah, I mean, inflation certainly is very, very persistent and stubborn. The problem is in two areas. One is the service sector and also shelter. We continue to see strong real estate prices and service that continues to be quite strong. Today's action was not comforting, as both S&P and NASDAQ downside reversed, and they're now below the 50 and 100-day moving averages. And thirdly, I would say the U.S. Treasury bond auction that went on this week, the demand was weaker than expected, prompting the yields to elevate. So certainly, not a good setup after today. We do expect a little bit of a downside. In the meantime, the breadth of the market has made some improvement in the last couple of weeks, but so far only 33% of the New York Stock Exchange stocks are above the 150-day moving averages. And so we may see breadth continue to narrow in the coming days due to the poor index performances today. So that's what's going on today.
All right. Dean, a few days ago when you joined in, you were telling us that you expect, I think, the U.S. bond yields to move a little bit higher from here, maybe move towards around 5.25% odd. We were cheering earlier this week that we saw it cool off to around 4.5%, but overnight again it spiked up. How do you see that one moving?
Yeah, I think, we're kind of in a gray zone at the moment. The next resistance is at around 4.8, which was the previous peak when we spoke. And after that, it'll go straight to 5.25. So given the hotter than expected CPI print, I think there's greater probability that we will surpass the 4.8 and potentially move towards 5.25. Certainly, the dot plot would suggest that the market is expecting one more rate hike. This may come in November or December. It would be a very welcoming positive surprise if the Fed were to come in and say they're going to pause for now. But looking at the CPI print numbers, I think we should brace for another rate hike.
You're saying the U.S. 10-year yield can head immediately to 4.8% and then eventually to 5.2%. You're expecting some downside in the U.S. markets. How much more? U.S. markets have already slipped 5, 6, 7% from their 52-week highs. How much lower do they head?
Yeah, right now, the S&P, for instance, they're below the 50 and the 100-day moving average, but there is some support at the 10-day moving average, which is 1% below. So given the strong performance of the mega cap stocks, I wouldn't be surprised if we do find support there. And we'll see what happens with bank earnings tomorrow morning. And if we get some, really bad print, that may send the signal to the Fed that they ought to be easing or stepping back from the hawkish view, particularly for smaller regional banks. They have yet to report, but we may see pretty poor performance from regional banks, and that may tell a story in terms of what's really going on in the economy. And so we do see some support at 1% below here. And, it would be a good sign if the market can bounce. And like I said, the mega caps, tech stocks in particular, they're acting pretty constructively at the moment.
Well, the question is then, for all of this that happens in the globe, what happens to India? The Indian markets have been extremely resilient, and for good reason. Your thoughts on how long this resilience can continue? And in light of the global uncertainty, do you think India will continue to be, the place to be despite the valuations?
Yeah, I think it is. We're looking at charts technically with a fundamental view. It certainly helps that the oil price is kind of stabilizing and coming down. And the US dollar is, coming down a bit as well. US dollar may edge up because of rising rates. But given the fact that, both oil price and US dollar has been some sort of an issue for Indian market in the past, but I don't see a particular spike in those two areas. And coupled with that, the fundamental drivers for Indian companies are quite strong. You have very strong domestic demand as well as export demand as well. So it's not uncommon to see, stocks growing 20% in earnings. And so I think Indian market will continue to be very resilient.
Yeah, Dean, you had a view on the Indian IT names as well. I think you were leaning more towards the mid-cap IT stocks. You can correct me if I'm wrong. But I also think that you had said that large-cap IT is now looking constructive. Last couple of days, my colleague Rima was telling us these numbers have been a little bit weak and the guidance is even weaker. What's your view on the IT names?
Yeah, I mean, they were looking pretty constructive, but now, given the fact that, we may see another rate hike, and we may see, implication of that is, slowing economy in the U.S. So it may take some time before we see large cap tech stocks like, Infosys and Tata Consultancy to, break out and outperform. Just today, Accenture, was down quite a bit. So I take cues from that. And, now we're seeing some, headwinds for large cap Indian names.
What about other names like HDFC Bank, Reliance Industries? Now, both these two stocks have been big drags on the market. Fundamentally, all the people we speak to seem to suggest there's nothing wrong. In fact, these are good long-term buys, but technically they appear to be pressured. Do you see some upside constructive positioning in HDFC Bank and Reliance Industries from here?
Yeah, I mean, from our perspective, we're looking at the charts from a technical basis. We do see a lot of resistance for HDFC Bank. They're going to have to work through a lot of resistance levels. But on the flip side, I do see a lot of interesting financial names in India, particularly in consumer finance. So, for instance, L&T Finance, Cholamandalam, Bajaj Finance, Equitas Small Finance, all of these companies are doing great. And then on the public bank side, that appears to me to be more interesting, particularly Federal Bank and Bank of India. They're just breaking out from early stage basis. So I would focus on these names. I think the large cap private banks, they have ways to go before they can work through those resistance levels.
All right. Finally, before we let you go, your thoughts on the consumer sector in India, Dean? Because, rains were a little deficient in the month of August, perhaps some bit of September as well. But the second half, people are looking at some recovery because of the festive season. At the valuations at which they trade, would you dabble into any of them?
Yeah, I mean, for instance, Varun Beverages look great. EIH, Wellspun India, Sarah Sanitary Ware, Amber Enterprises. These are all names that are just breaking out and ready, to go higher, in my opinion. So I think these are the names to focus on.
Always good speaking to you, Dean. Thanks so much for stopping by. Wishing you a good Friday ahead and appreciate your comments as always. Well, let's move on then. Let's focus on the India economic data. We were talking about the US economic data, which is looking red hot, and that's a worry, and the yields have gone up. But out here, things are looking good because India's September CPI came in at around 5%. That compares with our poll of around 5.5%. And also, we had the August industrial output number that came in around 10.3%, which is higher than we're working with. Lata joins us to tell us how she's reading the data. Well, Lata, it looked quite good, right?
Well, it was a double delight when it came to the macro numbers that were announced yesterday, both on the inflation and on the growth front. Inflation lower than expected, growth higher than expected. What more can you ask? But to get to the inflation number, which is more crucial for policy making, at 5%, look at the way in which it's fallen month on month, 6.83 the previous month and 7.44 in July. Clearly, that tomato-led spike now looks like a clear one-off. And in particular, you go away from the headline CPI and go to the food CPI, the fall is really important. The food index has fallen even month on month by 1.8%. And year on year, again, the slope is very steep. It has come at 6.56 for September. It was at 9.94 in August. And it was 11.5% in July. So consistent fall. And now there is even a month-on-month fall in the food index. Like I told you, 1.8% lower. The one that's most responsible for the fall in food prices, vegetables, down 15.8% month-on-month. So the big worry is clearly over on food inflation. The one that has always been doing well did even better, and that's core inflation. Core inflation is down to 4.5%. From 4.8% in the month of August, and it used to range at about 6% in January. And core inflation is sticky, takes time to come down. The fact that it's at 4.5%, pretty close to the Reserve Bank's 4% target, makes it an extremely important number. But let me point to just a couple of areas of worry. They are basically pulses and cereals. Pulses are still up 16.4% year on year. And even on the month, it was up 4%. Important ingredient of the Indian thali. Likewise, cereals up 11%. So one would worry about pulses and rice, whether going forward we're able to keep it under check. Spices are 23%. You can't do that. You can't do anything about it in a year or in 6 months. But they are a small weight in the CPI. To that extent, we can proceed. But the important point is coming in at 5%. Now, most of the economists whose full year CPI was way ahead RBI's forecast of 5.4% are all now bringing down their forecast closer to the Reserve Bank's full year forecast. But the big question for the bond market will be, having got this 5% CPI, will the Reserve Bank soften its open market sale of bonds, which it announced in the policy? That much may be too much to expect because the Reserve Bank always expected only a 5% inflation in September. It's come according to their expectations. So the market mulling this, we will have to see how it reacts. But clearly, very bond positive number, although the US number is not bond positive. Both PPI and CPI in that country have come in higher than expected. But one big worry less for India. Quickly on growth, 10.3% August industrial output. Let's not take our breath away and become too overconfident. This is largely because the year ago number was minus 0.7. So on an average, if you take year to date, we are still around that 5% industrial output growth. Again, consumer durables looks excellent at 9%. But then that was because year ago in August 22, it was minus 9%. So we've not made much progress in terms of production, except for capital goods. Capital goods are really taking it away. 12.6%, not on a bad base, 4.3% base. So capital goods, as we all know, capex is doing very well, but we can't say as much about consumption items. So growth, good. Inflation, very good.
Right, growth good and inflation very good. The question is how much of that will be impacting the RBI policy, how much the global news will impact what they do as well. With that, we'll simply do a short break. Thank you so much for that, Lata. On the other side, we focus on the micros. Our top 10 list of stocks lined up next. Welcome back. If you've just logged in right now, we have the GIFT Nifty, which is indicating a sharply lower start for our markets, a 150-point downtick, and that's largely because of weakness that we've seen in the US markets overnight, owing to hotter than expected inflation and weak numbers coming in from Infosys, the IT pack as well. So to detail all these individual stocks which will be in focus today, we have the CNBC-TV18's top 10 list of the stocks. Let's talk about Infosys itself. That's the one that's beat estimates in the second quarter, with the revenue growth coming in more than 2%. But the fly in the ointment was the company lowering their top end of the full year revenue growth outlook from 3.5% to 2.5%. That's a stock we'll be watching out for, as the Infosys ADR was down almost 7% overnight. The other stock we'll be watching out for would be HCL Tech. The revenue growth has marginally missed estimates. The company's lowered their guidance, even as margins beat estimates. The brokerages believe that despite the underperformance of the stock, there could be room for further downside on HCL Tech as well. So those are a couple of stocks we'll be watching out for. And that's not all. In fact, we'll also be speaking with the management of HCL Tech at 9:30 a.m. here on CNBC TV 18.
All right. Let's focus on the other couple of names. Mangalam, you're tracking Indigo, going by train tomorrow, but tracking Indigo for today.
Yeah, because you can't afford the Indigo flights. And the good news is that they're the only, game in town when it comes to market share. The kind of gains that we've seen in Indigo's market share. So two things really stand out. The first one, of course, is the overall passenger growth has been around 29% year-on-year, 18% month-on-month as well. And that's data that comes in for the month of September from DGCA. Importantly, Indigo's market leadership continues. So their market share is close to around 63.4%, and that's followed by Vistara, which is around 10%. The Air India group on the whole, which includes Air India, Air Asia, as well as Vistara, is close to around 26.2%. SpiceJet and Akasa are close to around 4.4 and 4.2. The biggest reason why perhaps Indigo would have benefited is, the absence of Go Air or Go First from the skies itself. A couple of months ago, the market share that Go First commanded has now come to Interglobe itself. So they have benefited from lack of competition. The question now is, with Akasa slowing down operations as well, will there be more market share accruing to Interglobe Aviation or not? That's something we'll be watching out for. And secondly, the big positive for them is that crude has remained range-bound despite the global volatility that we've seen. So at around $86 per barrel, maybe this would be good, and that they've added some fuel surcharge as well. So it's more, market share in airspace being gained by Indigo.
Well, that's perfect, right, Mangalam? Go Air, that 6.4% that they had in April, the entire chunk has gone to Interglobe because their market share went from around 57% to around that 63% odd. Let's move across to Ekta. She's here because she's tracking a couple of those pharma names. Morning, Ekta.
Morning. I'll start with Lupin, which is in focus because they've received a tentative US FDA nod for a particular drug which is used for narcolepsy. So it is called X-Wave Oral Solution. Its size is $958 million for the year ending December 2022. The company has said that they are exclusive first to file and may be eligible for 180-day exclusivity on this particular drug as well. Separately, I'm tracking Dr. Reddy's because their Bachupalli plant, the biologics manufacturing plant, is issued 9 observations by the US FDA. There was a pre-approval inspection, which is generally for products which they've filed for and they're seeking US FDA approval. The inspection was from the 4th of October till the 12th of October, and they've been issued 9 observations, so that particular stock could be weighed down in trade today.
All right, Ekta, thanks a lot for that. Meanwhile, just keeping an eye out on Emphasis as well. This morning itself, they've announced an acquisition. US-based company Sonic Partners for almost $132.5 million in cash. That's close to around 1,100 odd crores. The revenue of the company that they acquired over the last few years has increased from 54 million in CY20 to around 76 million in FY22, or rather CY22 itself. So that's a 50% jump that we've seen in just about 2 odd years. The acquisition has valued the company at close to 1.74 times sales, and it adds to 4% of the company's overall revenue. It will be interesting to see how that goes. The street likely to like it, but with the overall weakness that we're seeing in the IT pack, let's see where the stock goes, Nigel.
Okay, all right. Well, let's hop across to Upasna. She's here to tell us about some earnings that came out post-market hours. Angel One and Anand Rathi. Upasna?
Anand Rathi Wealth has recorded a good set of numbers in Q2 FY24, and in terms of AUM growth, we are seeing a double-digit AUM growth of almost 10% sequentially. Revenue from ops saw an uptick of almost 4.3%, and PAT saw a growth of almost 8.5%. The company has also raised its AUM growth guidance for FY24 from 47,000 crores to 51,000 crores. It has also raised its revenue guidance for FY24 from 661 crores to 720 crores. Now, next up, moving towards Angel One. Angel One has also recorded a good set of numbers in its Q2 FY24. The revenue saw an uptick of almost 30% on quarter-on-quarter basis. PAT also saw an uptick of almost 38% on quarter-on-quarter basis. The client addition also saw a growth of almost 60% on quarter-on-quarter basis, and the company's client base expanded by almost 13% sequentially. The company's average daily turnover also saw an uptick of almost 30% on quarter-on-quarter basis. So all in all, we are seeing a good set of numbers coming in from Angel One.
All right, Upasana, thanks a lot for that. Meanwhile, Nigel, you're watching out for some other numbers as well. Kesoram, Case in Point, and GMR Airports too.
Well, that's right. Kesoram because of their numbers and GMR because of the operational update. For Kesoram, those numbers look disappointing. On the top line, there was a growth of close to 13%. That's because volumes have gone up. So that's good to see that they're maintaining their market share and maybe increasing their market share. But it's come at the cost of margins because the improvement on a low base is only 130 basis points odd. Why is that? There was some cooling off in other expenditure, but power and fuel as well as packaging and carriage costs, they continue to remain elevated, which is a bit of a worry. Then they delivered a net loss and their finance cost has gone up yet again by close to 9%, though the management has been talking about paying some part of the debt off. So we'll have to find out why exactly. If they're paying even 50-60 crores, why should the finance costs go up? So we'll find out that. The other problem is they have this rayon and chemicals business, which continues to remain, deliver a net loss. The only positive for them is that on an EV basis, it trades attractive at close to $50-53 per ton basis. And the street will be waiting by for any kind of commentary with regard to refinance, repayment of debt. We'll try to get you the management in the next 1 hour or so to clarify on why these numbers look weak and should we see a bit of an uptake from here on. The next one we're looking at is on GMR Airports. They've declared their total passenger traffic growth for the month of September. Mangalam was talking about, the airline stocks earlier, and it seems there's plenty of interest out there. So 23% growth on a year-on-year basis gets a thumbs up. So that one as well should open up in the green. But for the time being, let's do a quick recap of all the top stocks we're looking at. Stocks with positive news flow. They include IndiGlobe Aviation, Lupin, Emphasis, Anand Rathi Wealth, Angel One, and GMR Airports. While stocks with negative news flow include Infosys, HCL Tech, Dr. Reddy's, and Kesoram Industries. Okay, those are all the top 10 stocks that we're looking at, but plenty of brokerage notes came in earlier today, and Sudarshan has gone through all of them. He's picked up a few to narrate to us. Hey, Sudarshan, morning.
Good morning. In the brokerage corner today, I have two stocks in my list. First one is NTPC. Bernstein has an outperform call with a target of 274 per share. It highlights four catalysts. First one, commissioning of new plants. Second one, potential renewable wins. Third, tenders for new plants. And last is regulatory order. Also, talking about the businesses, Bernstein says in thermal, no one else is adding capacity, but NTPC is. In renewables, no one has as much money as NTPC is. Also, it has a huge advantage on borrowing cost and receivables. In green hydrogen, private players are making a beeline at NTPC to build renewable energy power plant for their green H2 project. The second one in my list is UBS on Axis Bank. It has downgraded the stock to neutral from buy and target is cut to 1100 from 1150 per share. It says margin is nearing peak levels and credit costs are almost at the bottom. UBS expects ROA, that is return on assets, to contract in FY25. It expects single-digit NI growth in the next 3 quarters. For FY25, UBS expects ROA to moderate to 1.5% from 1.76% in FY23 and ROE, that is return on equity, to moderate to 14.9% from 18.2%. On valuation front, it's trading at 1.9 times FY25 price to book value, which is near to its 5-year average. Factoring all these, UBS believes there is a limited upside potential in Axis Bank.
Sudarshan, thanks a lot for that. NTPC and Axis Bank are the stocks that we'll be watching out for on the back of brokerage commentary. Positive for NTPC, not so much for Axis Bank. But that's about the equities arena. Let's get in Manisha for a quick roundup of all the action from the commodities market overnight. Manisha.
Thank you so much for that, Mangalam. Well, I'll start with the metal prices, where we are seeing some support continuing. So copper is keeping above its 4-month lows. We also saw the iron ore prices continue to gain up. The dollar index is still off its 11-month highs, and China is talking about yet another stimulus. The economic data that we've seen in sense of inflation from US also seems to be on the positive side, and that has been supportive. Same is the case with the crude oil prices also, while of course there is some pressure because we've seen the US production at a record high, and the US inventories have gained up by a big 10.7 million million barrels. But on the other side, there are now U.S. sanctions coming in on tanker companies carrying Russian oil above the G7 price cap of $60 a barrel. That seems to be really supporting the markets right now. With these caps coming in, the discounted cheap crude from Russia could perhaps be curbed, and markets are weaving that premium into the prices. In any case, we yet to hear the last word from the Palestine and Israel conflict, so markets keeping that premium in the prices also. So the Asian markets working with nearly a percentage point of gains for the crude prices right now.
All right, Manisha, thanks a lot for that. So that's all the roundup coming in from the commodities arena. With that, we'll take a short break. On the other side, we'll have Nishal Maheshwari of Centrum Broking coming in for some fundamental stock analysis. Stay tuned.
Welcome back. Well, the markets are indicating, the GIFT Nifty is indicating that we pulled back 150 points, and that's courtesy some of those IT names. So let's start analyzing them itself, and let's get in a view. We have Nishal Maheshwari, the CEO, Institutional Equities and Advisory at Centrum Broking, who joins us. Hi, Nishal. Good morning. Well, IT stocks could open up a little bit under some pressure. The only, solace is the last couple of days they have as it has been weak, and maybe that's normally a place that you look to hide. Would you be a buyer on this dip?
Morning, Nigel. Yes, I think so, basically, given that the price is already off. I think these kind of results, whether it was TCS or Infosys yesterday, I think the only disappointment which I see is basically the guidance which both Infosys and HCL Tech has cut. So that is the only disappointment I see, basically. Otherwise, I think these results were more or less as expected.
All right, so that's your view on the IT pack. Nishal, good morning. Just wanted to know your thoughts on the banking space. I mean, you've been positive on the PSU side of things a lot more than the private side. But now with the PSU stocks, PSU banks having outperformed a lot and some momentum being built in private sector banks, do you think you would make that shift now? If yes, then where would you go?
So I have been positive on the large cap PSU banks, not all of them, because we don't cover all of them basically. But yes, having said that, I think we would continue to hold on to the PSU banks for the moment. I think at least for the coming next 1 or 2 quarters, they will continue to outperform the large cap private sector banks. So for the moment, I think it's PSU, large cap, PNB, SBI. these are the ones basically which we cover and we like them at the moment.
Nishal, which sector or group of stocks could be the dark horse in this earnings season, according to you?
So I have to really think about that. Actually, what could be? But so now, nothing comes to my mind. It will be the dark horse. I think more or less the earnings are pretty much expected, basically, and I think mostly most sectors would be able to deliver that.
What about consumer discretionary? Of late, we're getting a lot of voices saying the consumer discretionary looks poised for some strength, given the upcoming festive season. Would you concur with that? And in consumer discretionary, what would you bet on? Would it be the four-wheelers, or would it be the apparel textile companies, the hotel companies? Your thoughts on consumer discretionary and what your ground-up checks seem to be suggesting?
So our ground-up check is basically that the retail continues to remain weak, whether it's in the apparel company or is the footwear companies. Basically, mostly the retail has been pretty weak in the second quarter. As far as hotels and all, I think there the ARRs are quite good, basically, and it continues to be strong on the back of current World Cup, which is going on. As well as the tourism demand. The other consumer discretionary, autos continue to remain pretty good, and we continue to believe basically that in the coming quarter also auto will be still strong. So I do not see very strong revival as far as retail is concerned. Apparel, retail, apparel and all, I think it will be a slow recovery, because we are not seeing any signs as yet of a recovery basically on the retail side. So it's going to be a slow grind.
Okay, all right. Nishal, since you're talking about autos, some of those stocks have done very well. Even look at something like a TVS Motors. A stock last couple of days, there are I think 2 or 3 brokerages that have gone ahead and upgraded the stock. What do you like from there, from the auto pack?
So, given that most of these stocks have done really well, basically, I think this time we would actually want to bet on the two-wheeler space. This is on the back saying that this is going to be a good festive season. We believe basically that there is going to be a revival on the rural side. And that's why we are saying basically Hero Motors could be the dark horse here. So that's what we are looking for, basically, two-wheeler space within that Hero Motors.
All right, two-wheeler space, and within that Hero Motors, that could be the dark horse. If I was asking for a dark horse, perhaps this could be the one. Nishal, you've liked manufacturing in the past. What from there do you like right now, and how would you play that theme?
So I think one theme which has recently emerged is, though it is a bit stretched, but I think the recent government announcement on the mining side, I think this could be a big potential play as we go ahead. There are a few companies in that space, because I think all the other themes have been played out well, whether it was power, whether it is defense. These are all capex oriented. So I think this mining thing can really work well. So besides the mining companies, I think there are 2 other companies within that space which should do well. Though it's not going to be immediate, it's going to be in a long-term way. But one of them is solar industries, basically, because all mining uses explosives. So solar is going to be one of the beneficiaries. Rather, the whole explosive sector is going to be a beneficiary. And the second one is AIA Engineering. They produce consumables which go in the mining equipment. So I think these 2 companies is what we are now looking at, saying that they could be the bigger beneficiary of the government recent policy on mining.
Okay, Nishal, from the core mining names, I mean, these obviously they're indirect plays, but from the core mining companies, which ones do you like? Yesterday I was a little bit worried about stocks like MMTC moving up. I hope they have a big revamp in their plans going ahead. But the float is very limited. They haven't made profits in a long while from now. And, the stock was up 20% actually. The core mining names, though, you had NMDC that was up, you had GMDC that was higher.
So I think, though we don't cover any of them except for Coal India, I'm not sure actually Coal India will go into any of the other spaces, but I think NMDC is a company basically which I would actually still want to explore. But I think a lot of the private companies might come in basically which have mining and exploration. So I think we have to look for which are the new companies which get the licenses.
Got it. Nish, I'll request you to stay with us for a bit. For the time being, we'll slip into a short break. On the other side, Shrikant Chauhan as well as Shilpa Rod will be joining in to give us some technical trading ideas.
Welcome back. There's been no amelioration in the opening that the GIFT Nifty would suggest. So that's something we'll have to watch out for. Shilpa Raut, who's the senior analyst derivatives at Prabhudas Leeladhar, and Shrikant Chauhan now join in. Shrikant, of course, is of Kotak Securities. Shrikant, your thoughts on what one should do when the market opens lower? Would you immediately go long, or will you wait for some time, some important levels before buying this dip?
Good morning, Mangala. I think, the markets are like, it was showing a lot of strength when it was going up. But on the date of the announcement of Infosys result, we saw some sideways sort of activity. And today, as the GIFT Nifty is suggesting, we are going to see lower opening. But somewhere close to 19,600, 650, the market is having excellent support. And the way the GIFT Nifty is indicating us, if we see the market is opening on the same line, then there certainly we should look for adding some position, because this market is the market of taking contra positions in the market. So whenever the VIX is between the range of 12 to let's say 10, all these contra strategies works very well. And yes, if there is any lower opening close to 19,650, we should be buyer in the market. But we have to keep stop loss somewhere close to 19,470 because the overall option interest is now at 19,500 level. So that is going to act as major support for the market. For the bank nifty, there also 44,300 and 44,200 going to act as major support for the market.
Okay, all right. Got that view, Shrikant. And by the way, guys, it's Friday.
Yeah.
It's the 13th.
The 13th.
So let's see how that plays out. But let's welcome Shilpa as well on the show. Hi, Shilpa. Good morning. Good to see you early this morning on the channel. Tell us what's your call on the Nifty as well as the Nifty Bank.
Good morning, Nigel, and thank you for having me on the show. Talking about indices, we see that the range in between 19,600 to 19,850 is where the maximum concentration on open interest is there. So any dip buy towards 19,600 should be a blind one. And we might book profit again at around 19,850. A decisive move past that, we will see targets opening up towards 20,000 to 20,100. Likewise, Bank Nifty also has a very strong support at around 44,300 on immediate basis, and we also witnessed a good short covering to the tune of around 4% yesterday, 2.8%. And in that regards also, we see that the FIs, they have marginally, of course, they have increased their longs to now 29%, and Bank Nifty is better placed than Nifty on current scenario. So for me, a good buy would be in Bank Nifty. There are many stocks that are on radar that can show some sort of outperformance from here. So Bank Nifty is a place to be from.
Shilpa, you want to help us with some stocks and any thoughts on Infosys in particular?
Yes, of course, Infosys, as expected, it might take a beating today, but we know that this weakness has been blooming and everybody was expecting this sort of fall. So Infosys, the stop loss of 1440 from here, one can attempt a contra buy and we can see 1500 to 1520 zones coming soon. So Infosys will be a buy for me on declines to 1440. And talking about other stocks, I believe it's like Friday the 13th. So I have a good buy on UBL today. I believe UBL is trading at around 1600 zones. This is where we have a very strong support. From here, I believe 1630 to 1640 can come in. The other one, like I said, because I believe Bank Nifty is better placed, so I have a buy on Bandhan Bank. Bandhan Bank also, attempting again a breakout, and it can do 260 to 265 zones. Keep a stop loss at around 245 from here. I believe it is also very well placed for a good upside.
All right. Looking at UBL and Bandhan Bank. Shrikant, your individual stock picks?
Yeah, I would like to go with those stocks which are technically very strong and they are very close to their important levels. Both these stocks have crossed their immediate highest levels. So GAIL, Gas Authority, is a buy at current levels around 127, 128. We are expecting this stock to move towards 137, 138 in the near term, and we can keep stop loss somewhere close to 124. Also, we like NMDC, which is around 159, 160, and there also the formation is indicating us that it is forming cup with handle formation. So the next level to watch out for would be around 180. So it's a buy at around 160 levels with a stop loss somewhere close to 154.
Okay, thank you very much for joining in. We'll slip into a very short break on that note, but just bear in mind that Asia is firmly lower. Hang Seng has extended its losses. It's now down close to about 1.8%. Shanghai, too, is staring at a cut of nearly 0.5%. China's exports and imports have again dropped in the month of September, though the decline in exports is a little less than what the street was anticipating. But the trade data is a bit subdued there, and Asia is low. Hang Seng now approaching a 2% fall there. But even the other key Asian markets are under pressure. Get into a break. We'll come back with the pre-opening. We'll also invite Apurva Prasad of HDFC Securities to review the Q2 performance of the tech companies. Welcome back. The GIFT Nifty is suggesting it's going to be a weak start, down close to about 140, 150 points currently at opening. This is courtesy the weakness that we've had in global markets. There is a risk of following the US CPI inflation print. Asian markets are selling off. Hang Seng is down close to about 2%. IT could weigh on the sentiment today, given the miss that we've had from big boy Infosys. The question is, will the other heavyweights like HDFC Bank, Reliance step up? And will this morning dip get bought into to some extent? Because this week, despite all the weakness, negative news that we had, the war, Israel-Hamas war, the spike in crude prices, the Nifty is still up close to about 0.7% on a week-to-date basis. So despite the negative news, markets have actually shrugged it off and have been fairly resilient. Let's get in a few F&O trading ideas. Sneha Seth, derivative research analyst at Angel One, is now with us on the show. Sneha, what's the positioning looking like right now? Any trade that you would recommend?
See, if we see Nifty, recently it has given us strength, but however, 19,800 followed by 20,000 is a strong hurdle. So I don't expect a major upside from here on. In fact, I would expect some profit booking from the higher level. So accordingly, we should be trading. In index, preferably it's better that we stay light in index. Someone who is holding a long position should prefer, lightening up the position at the higher levels. Now, if we talk about individual counters, I have two calls. First is buy on Chambal fertilizer. So that counter looks really good, and with a strict stop loss of 284, I would recommend buying on this. The target we can expect is around 304. Apart from this, I am I also like ICICI Bank for a put options trade. This counter looks weak, and I feel from here on we may see some corrections. I would recommend buying at the money put, that is 950 put options in the range of 15 to 17 with a strict stop loss of 8.5, and the target you can expect is around 27.
All right, those are some derivative trades. Sneha, thank you so much for joining in and giving us your calls out there. Let's talk about the standout brokerage report. Nimesh has parsed through all the notes that have come in this morning and tells us what has stood out. Nimesh, good morning.
Hi, morning, Mangalam. So I have a couple of stocks that stand out. The first one is SBI. A bit of an anti-consensus call from UBS today. So they've downgraded the SBI to sell from buy, and they've sharply cut the target price on SBI to 530 versus 740 earlier. They believe that best of the metrics for SBI is now behind. In fact, the return ratios, which have likely peaked in FY24, and they're likely to further decline in FY25. They believe that the repricing of deposits will cap margins and thereby keeping the NII growth in line with the loan growth of 10 to 11%. Well, the stock is inexpensive at one-time price to book on FY25 estimates, but declining profits could result in downside from here on. In fact, even the CET1 at 10.8% leaves a little cushion with regards to the regulatory tightening. So, on back of all this, a sharp downgrade on SBI to sell now from UBS, and they've got the target price now to 530.
Okay, all right. Thanks a lot for that, Nimesh. Well, Nishal Maheshwari is still with us. Nishal, what do you think about this note? SBI, if you wanted to play PSU banks, then this was supposedly the safest option. If it dips, will you buy?
Yeah, definitely. I think we still have a couple of quarters basically where the earnings are going to be pretty strong. So any dips in SBI, I would be a buyer.
All right, would be a buyer on dips in SBI. I just wanted your thoughts on Interglobe Aviation as well. I mean, we did get the data overnight from DGCA saying that their leadership is intact, in fact, only growing from here on. Now, with the additional fuel surcharge coming in, some weakness in players like Akasa, etc., stable crude prices and rising, number of people who are traveling, would you continue to back this theme? And if yes, then what are your thoughts on Interglobe?
So as a theme, I think tourism is done pretty well, basically, and this current quarter is going to be the busy season, both from point of tourism as well as business. So definitely, I think airlines as a theme is going to do well. Obviously, they being the market leader, continuously consolidating their market share and increasing it, I think they are the best placed, basically. Yes, in distant time, I think possibly Tatas are going to give them a run for money, but I think at the moment they are ruling the roost. So definitely one should be holding on to this stock at these prices.
What about particularly Bank of Baroda, getting back to the PSU banking theme? There was that negative news about how RBI has disallowed them from onboarding new customers on their mobile banking app. We know in the case of HDFC, when that credit card ban took place, they were disallowed for nearly 12 months. What kind of an impact are you penciling in for Bank of Baroda?
Not sure actually what kind of impact can happen, basically, because Bank of Baroda is not very that way. I'm saying RBI has only told them to not onboard not onboard clients through the app, but I think directly they can still do it. In case of HDFC, it was basically asking him not to issue any more credit cards. So I think that could have directly impacted the business. In case of Bank of Baroda, you can still do it by getting the customer into the branches and all. So don't see much impact happening, but they definitely need to spend more on IT. I think that is sort of a rap on the knuckles basically by RBI to Bank of Baroda. And I think the management is quite cognizant of that and is continuously spending on the IT upgrade.
Okay, all right. Stay with us, Nishal. Nimish doesn't have one today's standard brokerage, but he's giving us two. Double delight. Nimish, tell us, what else are you looking at?
Well, Nigel, the second standard note is on consumer staples. Some interesting changes Citi has made to the recommendation list. So, first, they've downgraded United Breweries to sell from buy, and they've got the target price there. And they've opened at 90-day positive catalyst watch on Nestle India. Now, coming first on United Breweries, Citi has downgraded the stock to sell now from buy, and they've got the target price to 1,500 versus 1,770 earlier. They believe that company is expected to deliver see a slowdown both in volumes as well as in growth, led by few important changes. One, continuing administrative challenges. They're seeing a market share loss in Karnataka. Second, supply constraints. It's already visible in Telangana, and that's now spilling over to Rajasthan as well. And third, company's own initiatives of curtailing the interstate sales. So, on back of all this, a downgrade on United Breweries to sell now with a target price of 1,500. So that's one big change that Citi has recommended to their clients. The second one is Nestle. This is interesting. They have a buy rating, but they've raised the target price now to 26,500 on Nestle India, and they believe that Nestle is going to outperform the peers both on earnings as well as in revenues, and at least in the next few quarters on a few important things. One, of course, the distribution initiative that's going to help the volumes. Second, launch of 10 rupee Maggi pack, which will boost the volumes going forward. And third, the margin tailwinds, which will come not only from price hike, but from the lowering of raw material environment as well. So, on back of all this, on Nestle, they've raised the target price now to 26,500.
All right, Nimesh, thanks a lot for that. It will be very interesting to see how these stocks move, mainly because yesterday we had positive initiating coverage on UBL. And for Nestle, of course, along with the results, they will consider a stock split as well. So that would be one positive thing to watch out for. And a lot of their margin improvement will come in from moderation in dairy prices. So those are a couple of things that we will keep an eye out on for Nestle. Nimesh, thank you for that. Rima, you have news on Infosys.
Yes, so pre-opening rates are here, and it's a downtick of 140 points on the Nifty, and the big drag could be Infosys. So Infosys currently at least is the top Nifty loser, down close to about 4%. HCL Tech also in the red. The cut is nearly 1%. So let's hear out why the Infosys management cut the full year revenue forecast. The Q1 numbers were good. Q2 numbers were a beat, 2.3% top line growth. Yet the company has lowered the full year revenue forecast, and now the expectation is in Q3 and Q4, the company is likely to degrow. The revenues are going to fall sequentially. So that was a bit perplexing for everyone on the street. So let's find out from the management on why they cut the guidance.
We are seeing the discretionary programs, the last transformation programs, they have reduced significantly. And we are seeing the decision-making continues to be slow. So as we've looked at this quarter, the volumes are still under constraint. And keeping that in mind, we've given a guidance for the full year. The large and mega deal wins really are positioning us very well for the future. We saw good growth in the quarter overall, so 2.3 quarter on quarter, 2.5 year on year. US was positive but small, and Europe was at about 5% in constant currency year on year. We've seen consistently, as you pointed out, over the last few quarters, the Europe growth has been stronger than what we've seen in the US. Some of that is a function of what we are seeing in the industries. So we've seen good growth in manufacturing, for example, and we've seen that reflected. Some of the countries within Europe, we've seen stronger growth. We don't break it out by country, but we've seen some of the countries doing quite well. We've also seen, for example, life sciences have a good growth across the company. While we've seen some constraints in retail, the overall growth year on year for retail is still quite strong.
That's more from the management of Infosys. Apurva Prasad, the research analyst at HDFC Securities, is with us on the show. Apurva, first, have you lowered your full year revenue forecast for Infosys? If yes, by how much? And how does the stock look if it does open with a cut of 4 to 5%?
Good morning. Thanks for having me. So, Rima, we have lowered our estimates. So, Infosys, we have cut that by about 3% or so, which is how much we have cut our fair value on Infosys. Is mostly a function of second half, which is going to be weaker than expected, as well as the deal conversion, which is taking longer. Some of the mega deals that they've got. About 3% cut in case of Infosys, about 1 to 1.5% cut in case of HCL Tech, and about 0.5% cut earlier TCS.
And valuations? How do the valuations for the company look now? Because you've cut your EPS estimates by 3%, so that changes the PE.
Yeah, so valuations, Rima, are long-term averages, so 21 times and 19 times FY25-26. So pretty much, if you sort of look at last 5-year, 10-year average, it's pretty much in that ballpark range. HCL Tech would be at a slight premium to their own long-term average, but then there are some reasons why they should be that they're paying out a lot more. There is a lot more free cash generation as compared to historically. We benchmark that to historical valuation. It's probably slight premium in case of HCL Tech. Infosys is pretty much in line with their long-term valuations. I think the mega deals they've got, that does give you good visibility for FY25. So if you X that out of FY25 growth rate, which is about 6.5% in case of Infosys and double-digit for HCL Tech, you're still looking at a very modest recovery.
Hi, Apurva. Good morning. Good to see you in. Nigel on this side. You know, we've got 3 disappointments actually. TCS, Infosys, HCL Tech. All the 3 stocks, are a little bit under pressure, or they were under pressure yesterday as well. Would you be a buyer? I mean, what's the official call that you'll have?
Morning, Nigel. So we've been saying that, look, the recent sort of outperformance that preceded this was more a function of multiples that went up, and it was probably more tactical, more a case of allocation, catch up to Accenture valuations and so on. And it was not really, earnings led. And therefore, we were expecting a limited absolute upside in the near term. So I think that stands. That does not change. Some of the macro stress. I mean, the big news really is that not much has changed over the past 2 to 3 months. So I think that sort of remains. The big positive, if you can bucket it under 2 things, is one, the mega deals, even though those get delayed, ramp-ups of those does give you good visibility onto FY25. And on the operational side also, with attrition coming up significantly and cost of replacement not being as high as earlier, I think some of those metrics are playing out, and which is why you see companies like Infosys and HCL Tech talking about improving their margin trajectory even beyond FY24.
Right.
So we do maintain our ad on that. I mentioned the earnings cut that we've done.
All right, quickly, before we let you go, Apurva, your thoughts on Mphasis, the acquisition that they've made, a US-based company, Sonic Partners, for about $132.5 million in cash?
Yeah, so I think what's happening in case of Mphasis is there has been a lot more non-BFSI focus. They were sort of more over-indexed to the BFSI side. I think they're trying to diversify the portfolio there. And what it does for Mphasis is H2 visibility is increased, and that's more coming from the bookings that they had, the 700 million plus TCV which they had in the previous quarter. They, of course, have been getting impacted with the mortgage business, which has been dragging their overall growth. But I mean, incrementally, the growth prospects are looking stronger for Mphasis as they diversify outside BFSI.
Any read-through for the rest of the IT pack, quickly?
Rima, so I think comms continues to be fairly weak. I think that's whether it's an Accenture, most of the companies have been I think that's a sort of common line. So TechM, it certainly has a much bigger portfolio for Tech Mahindra. So that would certainly be a negative read-through, which has been happening over the past few quarters, I would say. And yeah, again, some of the sub-segments within BFSI, incrementally commentary is not improved. So again, with some of the tier ones, I think are relatively more exposed. So I think that's the nature of it. Having said that, if you see HCL Tech, BFSI has been outperforming. Compare that with some of the peers. So we are company specific, it will be there. But yeah, I think comms being weak can be certainly one thing.
Okay, Apurva, thank you very much for joining in. Counting down to the opening, just a few seconds left. It's going to be a weak start, as the GIFT Nifty was implying. Maybe lower by 140, 150 points. The drag will come in from the IT names. So Infosys could lead the fall on the way down. Okay, the bell has rung. The first tick on the Nifty is down 120, 130 points. The Nifty opens at 19,650. Still down 140 points. Sensex has crashed 450 points. We're looking at a cut of 0.7% on the benchmark indices. The Nifty Bank has fallen by a similar amount, 300 points lower, 0.7% in percentage terms. Mid-caps in the red, but the fall is not as much as what we've seen with the benchmark indices. To take you through the big losers, Infosys is the top Nifty loser. Opens with a cut of about 3%, but this adds on to that 1.5% fall that we had in yesterday's trades. Over 2 days, Infosys has corrected close to about 5%. Other IT losers include Wipro, that's lost 1.5%. Wipro is the only large cap IT left to report numbers, reports on 18th, that's next week. Pull up an HCL Tech. HCL Tech has actually opened in the green, and here's the reason why. HCL Tech is guiding for a very strong recovery in the second half of the year, 3 to 4% every quarter in Q3 and Q4. So they're very confident. So they have lowered their guidance, but the guidance cut is because of what has already happened, not because of what lies ahead. So HCL Tech is bucking the trend this morning. TCS too, because relatively, TCS performance was not as bad. So TCS is open flat after the correction yesterday. Axis Bank has seen a cut of 1.5%. There was a downgrade by UBS. So Axis Bank and State Bank of India, both of them down 1.5% to 2%. On the gaining side, as we said, HCL Tech is the big surprise mover, 1.7% up. TCS in the green, SBI Life, Hero MotoCorp are some of the other stocks which are resilient. But on the whole, it's trimming its losses, now 100 points down. So open with a cut of 140, but now down 100 points.
Well, if you bought the dip, you'll be happy, right? You're already 40 points in the money as we speak. And just one more data point. We started at 19,653. We need to end somewhere around there or even higher to have a green week. So that's the important point. We moved around 19,700 odd. And just pull up the IT index. That's recovered a goodish bit. Stocks like Infosys, case in point, now they're down only around 2.5%. It was down close to 4.5% odd. So there's a big recovery that we're seeing in tech on the whole. LTI Mindtree has moved into the green. That's opened up in the red. TCS as well has moved into the green. So pretty good going on that front. The stock that I'm looking at is HDFC Bank. It seems to be finding its form in the second half of the session. Normally has numbers over this weekend. That's going to be the mover today. If that can move, that's what's going to help the bulls recover even more from here. We're up close to around 60 points from the low point of the day. So keep an eye on that front. A couple of stocks in the broader markets though. Aircon is up close to 5%. Good going out there. MMTC refuses to budge. The stock is up another 3% after going up 19% yesterday. Vodafone Idea is up close to around 1%. And Z Media, the last few sessions, it's been moving quite well. So that stock as well, on a low base, that's up more than 10%. Volumes rather high on that counter. Mangalam, but 60 points from the day's low already.
60 points from the day's low already, Nigel. The low on the on Infosys today is 1,400, and that's exactly where a lot of puts were written. So from those levels, we've seen a recovery of a good 30, 31 odd rupees on that stock, and that explains the recovery on the Nifty from the lows. A couple of broader market stocks that really stand out. One of them is HDFC AMC. Reported their numbers in the afternoon yesterday. The street has passed through them, the earnings presentation, etc. And that seems to be the top gainer in the F&O pack this morning itself. Among the losers, we do have United Breweries, which is down about 1%, was a good mover in yesterday's trading session. But Nimesh did indicate that, there could be some negatives. as reported by Citi for the company. Angel One from the broader markets doing well as well. Decent numbers coming in from them. And Kesuram, you've been talking about how, the EBIT loss in their rayon and chemicals business has expanded, as a result of which that stock is lower too. One stock really stands out in terms of moves from the broad markets is AGI Greenpack. Now, the stock has been a big mover. This year itself, it's rallied about 200%. So that's a 3x gain that we've seen from the start of this year. And this stock doesn't seem to be stopping, up almost 6% as we speak. The erstwhile HSIL now surging 200%. So it's hit the double century in terms of gains this year. RITES gaining along with Aircon. So the entire railway pack, we have Railtel, RITES, Aircon, all of them buzzing around. So the broader market actually looks a lot better than the frontline end of things. The mid-cap index opened with a cut of 0.4%, and swiftly, if you pull up the intraday chart of the mid-cap index, you'll see it's just about breaking into the green. So the underlying texture of the market continues to remain extremely strong, now down by just about 25 points for the mid-cap index. The Nifty too, firmly above that 19,700 mark.
Okay, let's get in some expert opinion on the way forward. How would you navigate all these cues? Mahesh Patil, Chief Investment Officer at Aditya Birla Sun Life AMC, is with us on the show. Mahesh, morning, and thanks so much for joining in. Rima here. Incremental money, where would you put it right now? Because markets refuse to fall significantly. We're just 2% off from our 52-week high levels, all-time high levels, actually. So if you have fresh money, which you keep getting, where are you deploying it?
Yeah, good morning. So, the markets have been fairly resilient, I think, despite, we've seen that some concerns coming in again from the global front in terms of interest rates, remaining higher for a longer period of time. And it's not in Indian markets itself. I think the global markets are also holding on fairly well. So at this point in time, again, I think the key risk what we see, right, going forward is likely to come in from the global front, because that's where the sharp increase in interest rates are. And that's likely to really lead to some kind of impact on the economy. We could see a slowdown coming in probably a couple of quarters down the line. And some of our globally linked sectors, which are linked to global growth, is where we'll be slightly cautious and try to stay away from that. I mean, unless the valuations really support that. I think India growth is still fairly strong and resilient, though it's nothing to really rave about. It's slowly picking up, but it looks to be much more steady. And a lot of the sectors, like, for example, if you look at real estate sector is doing very strong. If you look at across all the micro markets, the demand is fairly good. Inventory levels are low. So that sector looks good, and that will mean all the building materials should do well. Overall trade growth in the economy is also fairly strong. In fact, it's better than what you were expecting at the beginning of the year. And that should help the banking and financial services sector. Also, with rates likely to remain higher for a longer period of time, I think the NIM compression, which one was expecting in the banking sector, I think that will happen in this quarter, but I think you will see margins remaining fairly decent. So that sector also looks good to us. The auto sector has seen a good recovery in the last 1 year. But still, if you look at the volume, especially in two-wheelers and other sectors, they are still well below, slightly below or near the pre-COVID levels. So there is enough runway of growth going forward over there. So I think a lot of domestic-facing sectors are showing good amount of resilience, except some amount of slowdown in the discretionary side. But again, that we think should also come back. We have to watch this festive season. Also, the rural economy, which has been weak, and the sector, we are seeing some amount of now slow green shoots over there. They're still early. But being an election year, I think you will see some amount of money being thrown at the lower end of the population, and that should drive some amount of consumption also going forward. So I would say that sector specific, I think some of the domestics like banking and financials, for example, where we are still overweight, auto sector, real estate, consumer discretionary, are cement, are the sector, even telecom for that matter, right? So telecom has, in this kind of an environment, you require sectors where there is steady visibility, there are no negative earnings surprises. And the telecom sector should see a good amount. I think we have seen the peak of the capex cycle now this year on the back of 5G. And next year, you should see large capital free cash flows from some of the telecom names. I think we should drive the overall equity growth over there.
All right. Hi, Mahesh. Good morning. Mahesh, what's your view on the IT names, a couple of months ago, I think we were discussing, you had mentioned that IT could be a contra buy, when everyone's getting a little bit gloomy on it. These numbers are not too great with regard to the way ahead. Would you be a buyer for a medium to long term on the IT stocks?
Yeah, so IT, as I said, it's a contra buy because the near-term outlook there is weak, and we all know that, right? There's some concerns, discretionary spends are weak, and near term, it's still not clear where the whole US economy, when it bottoms out, again, when it does that. But so given that, I would say that in near term, after this couple of 2-3 large results, what we have seen, it seems that it will still take some time to recover from here. And to that extent, I think you will see the performance in the IT stocks would get pushed back. They still continue to maintain the view that over a medium term, long term, I think the whole move towards digital spending and tech spending is not going to slow down significantly, and we will still see growth rates which are slightly higher than what the pre-COVID run rate was, which was somewhere in the mid-single digits. So from that perspective, I think the medium long-term outlook for IT still looks good. And the Indian companies have still done pretty well. Some of the companies have, while the top-line growth has disappointed, on the margin front, I think they have shown better kind of a performance. There are some margin levers which are there in terms of improving productivity and increasing utilization, I think, which should support the earnings growth, right? While the top line growth will be slightly weaker, but the bottom line growth could be slightly better. So I would still maintain that it still remains a contra, but I think don't expect any near-term outperformance in the sector considering the global listing, but can be a good sector for, I would say it can also be a slight defensive in that sense, because a lot of negatives are already priced in or known in this sector. And there are other sectors, where we still don't know, what negatives could pop up, especially linked to global growth. So, yeah, so while remaining cautious on the IT sector, I think any correction, I think one should look to add over there.
All right. Seems like you've been a bit of a messiah for the mid-caps. As soon as you joined now, the mid-cap index has moved into the green, closing in on that 40,600 mark. A lot of the F&O stocks doing well. We have Vodafone Idea, which continues its march forward. So this week itself, the stock has rallied about 12%. So that's something we'll watch out for. Though, on an absolute basis, just a 12 rupees stock. So just watch for that one. Nippon Life yesterday was up around 12% towards the close, and this morning opened lower. Quickly that dip was bought into. That stocks moved to the high point of trade. But if you're looking at just the F&O stocks, then perhaps you're missing out on the bigger moves that we're seeing in the cash markets as well. ITI, that's up 7%. Zaggle Prepaid, a recent listing. We had the management here yesterday saying that incrementally they will see more revenue coming in from their new product, which is Zoyer. And at the same time, reduction in their finance costs would aid their profitability going ahead as well. Yesterday, it was a bit of a softish performance on the stock, and now it's up around 7%. Mahesh, earlier you had said that, the mid-caps and small caps are seeing a fair amount of flows and the outperformance is likely to continue. It has played out so far. You liked a couple of the new listings as well. Your thoughts on how long this outperformance can continue and at what point it becomes expensive?
So the mid caps and small caps in the last 9 months have seen a good rally, good outperformance vis-a-vis even the large caps and in absolute terms. So technically, if you look at in terms of outperformance and historically, if you compare that, then I think it reaches a point where I think one can see some kind of consolidation there, or even relative underperformance if the market's correct, right? Because the risk to mid cap and small cap is if there is a global risk off, then you will see a larger correction over there. But I think I still believe that mid cap and small cap stocks from a slightly long-term perspective, I think can continue to do well. I mean, valuations are higher there and performance, so you can see a short-term correction or a pullback over there. But we don't see any major concerns over there. Obviously, it has to be more stock specific, specifically in the small cap segment, because where the market is very, very diverse, right, over there. And there are a lot of pockets in small cap space where there's a lot of exuberance which has been there. So one needs to be more careful in that sense. But overall earnings growth for the companies is fairly good. And that's more important, right? While valuations are expensive, the earnings growth visibility is there and continue to grow. And a lot of, as I said, India's story looks good. Small caps specifically are more linked to domestic growth. So that should, I think, over a period of time, really take care for the slightly higher valuations which are there. So we are not aggressively pushing mid caps and small cap at this point in time. We're seeing that, okay, continue with your SIPs. Okay, don't do any lump sum over there. Large caps at the moment look slightly better. The risk reward is slightly better in the large cap stocks, and that's where the slight tilt should be. But for long-term investors who are looking at long-term wealth creation, I think small and mid cap they can continue to hold, and I don't see any major concern, because the direction I think still looks to be on the higher side, barring some minor pullbacks, okay, which can happen.
Mahesh, out of time. Thank you very much for joining in. Enjoy the rest of your day and the weekend and the match. Are you going for it?
Not really. Watch it. Yeah. Thank you. Bye. Good day.
Thank you. Thank you. Have a good day. By the way, Infosys is seeing buying from the day's low. It opened with a cut of about 4%, now down 2.5%, and it's holding above its 200-day moving average of 1410. But HCL Tech is the big mover, 3.5% higher as Q2 was a mixed bag. The company lowered its guidance for the full year, but the company is guiding for a very strong H2, Q3 and Q4. I had a chat with the management. Listen in.
We would have expected a little bit more of revenue, but if you look at the Q2 revenue breakdown, there is services, and then there are some assets which are also embedded into the services P&L, and then software. Our asset revenue reduced about 25 million. It's a very tactical thing that kind of dropped by 25 million based on some projects which where the execution got over. So other than that, if you take the services within services, it's a pretty strong growth. It's probably close to 2%.
Okay. So the only reason for the Q2 miss compared to expectation was this $25 million reduction in the asset revenue, right?
Yeah.
Okay. Yeah. Peers like Infosys are guiding for negative growth in the second half of the year. Your guidance implies a very strong 3 to 4% pickup in both Q3 and in Q4. What makes you confident that you will be able to achieve it?
Rima, first of all, the nature of our businesses are different. And if you look at our outlook for Q3, it's informed by three factors. One is the large deal which will go live by 1st of November, which is going to give us some significant revenue in Q3. The second aspect is for the software business, it is seasonally one of the top quarter, which means O&D will see a spike in the software business. And the deals that we have signed in the last 2 quarters, some of them, the transitions are over. They will go into steady state starting maybe end of October onwards. And also there is some flow-through impact of the revenues that we had in September, which will have a full quarter impact. So all of this adds up to a good outlook for Q3. And a similar extrapolation to Q4 is possible because even the large deal will continue to have an incremental growth in Q4 on top of Q3.
Okay. Just on that point about the Verizon deal, which will start contributing from 1st of November, how much will it contribute in November, December and Q4?
Rima, we do not call out client-wise numbers, but of course, a lot of optimism is built because of the we are going live, things are on track. I think that's what is giving us this optimism.
Prateek, can you tell us what led to the margin expansion, sequentially 140 basis points?
Yeah, sure. So there are 3 or 4 factors. I think if you see our cost breakup that we give in great detail, one of the pages of the investor release, there is a sharp reduction in the expense on third-party contractors, which is 70 basis points drop. Apart from that, other discretionary expenses like travel, like, legal expenses, other discretionary expenses also saw a sharp drop, 50 odd basis points. And then, of course, the headcount reduction also led to some savings there. So in total, we have driven a lot of cost savings this quarter, and that has delivered. It's actually 150 basis points improvement on a quarter-to-quarter basis. It is a 50 basis points improvement on a year-on-year basis as well. So that is, what drove that.
You are giving a wage hike from 1st of October. What will be the margin impact in Q3 and in Q4?
So Q3 should be about 60 to 65 basis points. And Q4 should be another 25 to 30 basis points on top of that.
Okay, 60 to 65 basis points margin impact in Q3 and about 20 to 25 basis points in Q4. Prateek, this cut in discretionary expenditure like travel, legal costs, are you embarking on some sort of a cost optimization, cost-cutting plan at HCL Tech? Because historically, your margins used to be, 19, 21%. That used to be your guidance 2 years back, and now you brought it down. So do you think the company, are you on some cost optimization plan to get back to those margins above 20%?
Rima, that's an excellent question and a very intuitive one. You are absolutely right. We have voiced our aspirational margin to get back to the 19 to 20% band. And that is what we are very laser focused on. This year is 18 to 19%. We started the first quarter week, as you know, 17%. So that was like little below. And we've ramped that up in the current quarter. And we'll definitely be in the 18 to 19% for this year. Obviously, it's a slow growth here compared to our, last quarter. Last year, same quarter, we had a services growth of 19%. Those days are gone. It's a different macro that we are going through right now. But as soon as the margins will also follow the revenue growth as and when we get that growth back.
CVK, just purely executing the large deals that you've clocked in over the last few quarters, including the current one at $4 billion, do you think double-digit is possible in FY25?
We have a very, very good large deal execution track record, right? Right from the days of Volvo to many, many large opportunities we've executed, which is across multiple geographies, multiple technologies, people, all of that we've executed well. And that's what we're going to do for the current strategic partnership that we have in hand. I think it will continue to give us good momentum going into FY25. But I think it's a little too early to kind of view what FY25 will look like. I think the planning cycles are getting a little shorter. Whatever plans you make may not hold good 3 months down the line. So there are too many variables at this point for us to get any sense of 25. But all that I can assure you is we will have a strong exit because Q3 is going to be a strong quarter. Q4 will be another strong quarter on top of Q3. So we will exit strong. I think I have visibility only till then. Then we will have to see as it comes.
So after this near $4 billion of deal wins in Q2, what's the pipeline and the funnel? I remember in our last interview, you said the pipeline and funnel is at all-time high levels.
Yes. So last quarter, it was at an all-time high with the $4 billion of closure. Obviously, pipeline has come down a little bit, but there is also a lot of new pipeline which has got added. So at this point, I am about 10%, to be precise, 9% below my peak pipeline. That's where we are.
Got it.
And a lot of that will convert this quarter and next quarter, which should give us some more momentum into FY25.
So deal wins in Q3 and Q4 based on your pipeline, which is still very strong. Will it be closer to that $4 billion or will it get back to that average of $2.5 billion that you've been seeing for the last few quarters?
Rima, to be honest, the $4 billion is an outlier. We've been clocking 2 to 2.5. So my aspiration will be to get closer to 2.5. Even though our baseline is generally 2, on a good quarter, we could get to 2.5. That's the kind of band that we are working on. 2 to 2.5 billion. And Rima, once again, I want to reiterate the bookings that we disclose are all net new bookings. These are all new deals, firm deals that is signed. This does not include rate card deals, framework deals. This does not include renewals. So it's really incremental commitment from the customers. That's what is counted in the new bookings that we disclose.
Very quickly, CVK, the performance was weak in manufacturing and technology. Do you see it reversing anytime soon?
See, manufacturing was a technicality. Initially, I talked about assets. 25 million was less, and that had a big contribution coming from manufacturing vertical. So, from a pure services, I think it will continue to do well. Technology, I think, we had a very small decline this quarter. I would say it will take a couple of quarters for the tech vertical to start showing good growth.
All right, that is a reasonably confident management of HCL Tech, eyeing the second half to be a lot better. And FY25, of course, will be supported by a bunch of deal wins that the company has done. The stock higher by almost 3%. Take a short break, come back. On the other side, we'll be joined by P. Radhakrishnan, who's the whole-time director and CEO at Kesoram Industries. Focus on what to expect from the second quarter numbers of the banking sector in our special segment, Quarter Se Quarter Tak. And to take that discussion forward, we'll be joined by Ashutosh Mishra, who's the head research institutional equities at Ashika Stockbroking.
Welcome back. We have a 70-point recovery from the day's low. Now, you'll be a little bit confused what you should do from here if you bought the dip. So we'll need to move higher, actually. And the Nifty Bank will have to perform because that leg continues to drag. The IT index, though, has come off considerably from the low point of the day. But we've been talking about a lot of IT numbers. There's another smaller company, Kesoram Industries, that reported an operationally weak set of numbers due to pricing pressure. The rayon business as well continues to struggle. The company, though, is likely to deliver far better performance in the next quarter. Mr. Radhakrishnan, the whole-time director and the chief executive officer, joins us on the show. Hi, Mr. Radhakrishnan. Well, these numbers look disappointing. No two ways about it. I think you'll be lucky to see just a 2% cut on the stock. But clearly, the street is looking at the way ahead. So give us a couple of details. A few days ago, you joined us. You told us you're likely to push through a price increase, both in South India as well as in West India. Has that price increase been absorbed?
It's been crystallized at rupees 30 per bag on an average as we speak.
30 rupees per bag. Okay, all right. That's been absorbed both in West as well as in South as well?
Yes.
Okay, so that'll be good then for your profitability. Now, at the end of the first quarter, first and second quarter, your EBITDA per ton is still, hovering 550 or a little lower than that, maybe closer to around 500 as well. On an average, it's lower than 550. But you have been telling us that you're looking to do 650 rupees per ton. And for the year, you'll do 8 million tons. Hold on to that guidance?
I do hold on to the guidance of 8 million ton as we speak. And we should be doing about maybe 650 should come anywhere between 625 to 650. Still, 650 is not out of reach. Plus or minus 25 rupees.
And this 625 to 650, you're referring to an average for the year, right? So that means the second half of the year will have to be closer to around 700 rupees to get to that number.
Yes, very much.
How sure are you, Mr. Radhakrishnan? Because, time and again, the street thinks that you all could downgrade it again. Are you quite confident now? Input costs have cooled off, but they're yet to reflect for you. And your price increases will help. So are you sure, or do you believe that still you'll be a little bit skeptical about this number of around 625 to 650 that you're talking about?
I think we should be there. The way I look at it is, there has been a decline in input cost in Q2, but it is not getting reflected in our number adequately as we have consumed from the opening stock, so far as the fuel is concerned. Therefore, this will get reflected in Q3 numbers as we move forward. Therefore, given this background, I'm confident we should be achieving close to what we have guided.
All right. Mr. Radhakrishnan, let's talk about the other smaller part of your business, which has caused a bit of a drag on your operational performance. That is the rayon business. Time and again, we've asked you about the break-even prospects of that business. When does that happen? And what does a sustainable operational performance look like for that?
Q4 of this financial year, we should be breaking even on rayon. And sustainable profit for that business will be about 45 to 50 crores of cash generation for that rayon. We are in a fairly, as I outlined, with a global major, we are in a fairly advanced stage to ink a definitive agreement. Once that is there, we should be in a position to scale up our transparent paper and rayon business.
So you want to ink, you're inking a definitive agreement to demerge the business, and then you want to scale it up.
See, first is to bring in the partner, do the definitive agreement, and then we will look at demerger. The first is to bring in the necessary technology to scale up.
So why not sell it?
And the infusion of capital. So once you bring in the partner and scale up, you get more value, whatever you want to decide at that point in time. Now the focus should be to create value in the business.
Okay. As Rima said, why not sell it? But you seem to be keen on running it. So we'll let you run it. Instead of demerging it, getting a partner, ramping it up, a better option. And the stock market will be very happy if you do it. But you want to run that business, so we take your point and you'll break even by Q4. So we'll hold you on that number. The biggest problem for you is debt. And time and again, you've said that, you're close to refinancing. Maybe there'll be some debt repayment. Now, give us two points. One, by when will you refinance? Is Q3 the time, sometime during the quarter, that you'll refinance the debt? Point number one. And also, I think you've repaid some part debt, or you had some small 30-40 crores of repayment that were due. Did you do that? Why exactly is this finance cost higher?
So what we have done is we have repaid whatever is coming up for November. So whenever there is a short spikes of liquidity, at the first instance, we try to repay the upcoming maturities. That's the way we function. Now, Q3, we should be through with either Q3, we should be through with the refinancing. Or if it spills over, maximum by January, February, we should be through.
So what happens to your finance cost? Because you had then told us that, you will look to reduce your finance cost to say mid-teens to low teens. What does it currently stand at? And post-refinance, what do you anticipate it to be?
Currently, it is at 19%. So the way it is getting delayed is we are not trying to target mid-teens now. Or we are trying to do below teens. Between 10 and 11% is what we should leapfrog. That will clearly give 200 crores of cash available for us. Right.
The street will appreciate your effort, Mr. Radhakrishnan. The problem is it's not happening. Q1, Q2, Q3, it seems like you're kicking the can down the road. So are you confident now? There's been various stocks. I'll tell you what the stock market wants. They want to see some kind of equity raise maybe to repay some debt. It'll give further confidence to the person who's going to be refinancing this debt as well. Are any of those two on, and could you be sure about it?
Good things take time, Nigel. So this will happen, right?
Yeah, but every
No,
we understand that good things do take time, but every time there is a good thing promised, then you look for a better thing and kick the can further down the road. Earlier it was mid-teens, then it was low teens, and now you're looking at high single digit, but you'd rather pay low teens now than pay high teens for the next 3 quarters, right? In anticipation of coming at high single digits. Just wanted to understand your thought process here, sir.
Yeah, we have come a long way. We have been perseverant in our effort. If you look at Kesavan balance sheet, 5,000 crore debt to 1,800 crore. That's where we have come. So we are absolutely confident it has paid off whatever we have done to bringing down the debt level to substantially lower levels. The only problem is the high rate of financing. We will definitely do that by this financial year. And I have clearly stated the quickest way to bring down is to bring in equity. What it takes us to bring in equity, we will bring into the balance sheet. That will be my endeavor as a working director in this
So
organization.
refinancing in the next 2 quarters and bringing in some equity as well is on the cards. Could it be a rights? Could it be a preference issue? What will it be?
Whatever it takes, whatever form it takes to bring in equity into this balance sheet.
But you're looking to raise equity. You're looking to raise some equity.
Absolutely. We should. Only thing I have to take it past the board once the contours are finalized. So we will definitely have once it is finalized and approved by the board.
Thanks a lot for joining in, Mr. Radhakrishnan. We're going to hold you to all these numbers, and hopefully next time around the goalpost doesn't shift. So you're looking at volumes of 8 million tons. The EBITDA per ton, well, that will have to move to close to around 700 rupees per ton for the second half, refinancing the debt, maybe raising some equity as well, and breaking even by the fourth quarter in the rayon business. Thanks so much for joining in. Plenty of promise. Now, delivery is the only thing the street will look forward to.
Okay, let's move on then to the big sector, the banking sector. This is our special segment, Quarter Se Quarter Tak. Abhishek is here to lay down the expectations from the banking sector this quarter. Abhishek.
Well, banking sector, thanks to the merger of HDFC Limited with HDFC Bank, saw robust loan growth of almost 20% year-on-year and more than 8% quarter-on-quarter at the end of Q2 FY24. However, the sector may continue to see pressure on the net interest margins, or as we call it, NIMs. This is on account of some key factors like cost of funds, which is rising, the end of loan repricing cycle, and incremental cash reserve requirement by RBI, that is ICRR. We may see managements lowering their FY24 or the near-term guidance on net interest margin than the numbers they gave after Q1 FY24. Deposit growth has been lagging the loan growth, hence one needs to watch out for the deposit growth for many banks. Incrementally, the system is at a CD ratio or credit deposit ratio of more than 78%. At a time when liability rates or deposit rates are at peak, the incremental cost of funds would be a costly affair for the banking sector. This can have a negative impact on the net interest margin of the banks. Now, private banks' pro forma business update has been pretty strong. They continue to take away the market share from the PSU banks. Expect slippages or bad loans in a quarter to be on the lower side and better recoveries to aid in improvement in asset quality or the gross NPA and net NPA. Operating profit growth could be weak due to weakness in the net interest income or the NIMs, but lower provisions can aid in strong earnings momentum and may see return ratios remain healthy for all the banks. Now, private banks may continue to invest in their franchisee, which could keep the OPEX or the operating expenses of these banks elevated. For PSU banks, expect strong improvement in their profitability and return ratios over the last few years or last few quarters to continue. We have some of the estimates from Kotak Securities. So for SBI, they are expecting NII growth of 24.4% YOY and a decline of 3.9% quarter-on-quarter. On the net profit for SBI, they are expecting it to go up by 175% YOY and a decline of 0.1% quarter-on-quarter. For ICICI Bank, Kotak Securities estimates NII growth of 20.2% YOY and a decline of 2.5% quarter-on-quarter. For net profit, they are expecting ICICI Bank's net profit to grow more than 25% YOY and a decline of 2% quarter-on-quarter. For Axis Bank, the NII growth is estimated at 15.8% YOY and about 0.4% quarter-on-quarter. For net profits, they are expecting it to go up by 9.7% YOY and about 0.8% on a sequential basis. Back to you.
All right, Abhishek, thanks a lot for laying down what the expectations for the banking sector in the second quarter would be. Importantly, the Nifty Bank currently at the low point of trade. We're seeing Axis Bank down almost 2%. There was a note coming in from UBS on that counter. SBI is the other one, which is down about 1.5% as well. As a result of which, the Nifty too has slipped mildly into the red once again, rather mildly around that 19,700 mark off highs as well. The Adani Group stocks have moved lower as well. Adani Ent, Adani Power, and Adani Ports, all of them at the low point. But let's talk about the banking space itself. Ashutosh Mishra, who's the head of research institutional equities at Ashika Stockbroking, joining us now. Ashutosh, we've had a lot of second quarter updates coming in from banks already, over and above what Abhishek has spoken about in terms of expectations too. What are your three key factors that you'll be looking out for in private and public sector banks this time around?
So the most important factor will be the deposit growth. Like I say, highlighted this time, what we are seeing that the bank is lagging on the deposit growth substantially compared to the credit growth. And especially if you look at the CASA deposit growth is quite low. So it will have a negative bearing on the NIMS projection of the banks going forward from here. So we will be closely looking at how the banks is managing their low cost deposit and NIMS going forward from here. Second important point I will be looking at, the loan growth is quite high and this most probably will moderate from here. There's a merger impact also which is getting reflected. So which segment bank is going to focus, where they are going to bring a next leg of growth, and especially when we are talking at this point of time that there is some early warning sign is coming into some unsecured retail portfolio. So how they are going to manage this dynamics of margins versus loan growth.
Ashutosh, in fact, talking about those early signs, warning signs that we are getting on the unsecured retail portion, just reading out the UBS note, which has come out on banks, where they've turned neutral on the sector and downgraded State Bank of India and Axis Bank. They're saying they take a deep dive into the unsecured retail loans, which has gone up by 27% CAGR from FY18 to FY23. They now account for 8 to 12% of the loan books of the banks that they track. They believe the risk of defaults is rising as the share of lending to the already overdue borrowers, that's 1+ day past the due date, has risen from 12% in FY19 to 23% in FY23. So that's a sharp increase, right? The overdue borrowers has gone up from 12% to 23% as of last year.
Yes,
how much of a concern is this, according to you? And can this really derail the entire banking story?
So we need to focus on 2-3 economic data points to see whether this will become a trend going forward from here, or it will just remain a warning sign where the banks will improve some of their underwriting practices to take care of this issue. So one most important factor will be how the spending both from the private and public sector continue in the government side, continue in the economic front. If the economic growth remain very robust in the next 1.5 years, at least from here, we are not going to see this becoming a major problem for the banks. Only thing it will be important that how the bank really change their underwriting standard on these loans and adjust for the increased risk which is getting built up at this point of time in the system. Yeah, this is time to relook into these underwriting practices which they currently are following for these loans, and slightly tightening up the process. The bank which will be able to do it, they will be a winner. Otherwise, yes, some banks may face the asset quality issues from some of these borrowers.
What are your thoughts on the sector positioning itself going forward? I mean, how would you, deploy, or what are your ratings on private banks, public sector banks, and NBFCs in light of the environment that we're in right now?
So my preference will be on the banks which have a relatively higher proportion of low cost deposit, especially CASA deposit is there. That is becoming a very important factor going forward from here. And especially the large, both private and public sector banks are well placed in this category. So in my view, smaller banks will face a much higher proportion of margin compression going in the coming quarters compared to the larger bank, where they are really having a high CASA ratio, and not at the only high CASA ratio, but they are offering much lower interest rate compared to many of the other banks which have high CASA, but at the same time, they are offering higher interest rate. So the deposit cost will be very important. Mix of deposit and is very important for me. And from that category, I remain very positive on the large banks, both in the private and public sector space out there. So yes, there is some underperformance is there at this point of time, but the way things sector is planning out, they will be much better going ahead. Second space which we really like is the microfinance. Things are a lot changing in that space, and there we are clearly finding there can be some good banks and NBFCs which can continue to deliver strong growth as well as profitability from that space.
Do you want to tell us your top 3 picks, taking into account large banks, MFIs, NBFCs, everything, including the top 3 picks for you?
So if you look top three picks, I clearly say the contra bet on HDFC Bank at this point of time. I clearly see this is a good time to look at this. The way things are panning out, they are very well placed to advantage. Second will be Bajaj Finance. I clearly see they are very well placed to, again with the recent fundraising and other, they are very well placed in. Third is the Bandhan Bank. It's a very good play on an MFI and the whole the things is panning out in the banking space. So these three will be the best pick from the banking space.
Okay, Ashutosh, thank you very much for joining in. Look forward to hearing your comments as the numbers start trickling in. It begins with HDFC Bank on Monday, the first time as a merged entity, the company will be reporting numbers. Get into a break. On the other side, we'll put the spotlight on commodities. Manisha Gupta joins in as always.
Welcome back. Well, the markets are trading with a bit of a cut, but let's focus on a couple of names, MMTC as well as ITI. Both of them have spiked up. They moved to the high point of the day. So just pull up the intraday charts of both those two. And volumes as well are picking up. But just need to caution our viewers on ITI, the total free float in the market is very, very limited. You have the promoter entity, which is the government of India, that has more than 90%. And then you have a special fund as well that's also a government entity out there. So basically less than 2%, 2.5% is in the market. And for MMTC, there's around 7% in the open market. So low float is a game that's playing out again out here. So just want to alert our viewers that take note of that before you take any calls on some of these stocks. The markets, though, they bounced up a goodish bit, but now they're giving back some bit of that. Mitesh Thakkar joins us to help us out with what you do from here. Mitesh, if you bought the dip in the morning, you'll be happy because you got a bounce. The problem is we've corrected close to 30 points again from the high point of the day. So for those that are playing the index, should they part book some profits and also give us your trading picks?
Morning, Nigel. My sense is they should book out the entire position. I think, today's gap down has definitely damaged the hourly and the 2-hourly charts. And while you were lucky to get some bounce back from a very weak opening, a gap down opening, I think, this market will see now in the immediate term supply at higher levels. So chances of us heading lower is slightly more. And therefore, I think taking profits would be a good idea. On the stock side, though, I have two buy calls. In fact, it's the oil and refinery sector, which is doing very well. I think credit to the prices of crude. So I have a buy on IOC which I would recommend buying with a stop below 89.5 for a target of around 94. And ONGC on the other spectrum is a buy as well. Disclaimer, we have some options positions on ONGC, so there is vested interest. But I would recommend buying here with a stop at about 183 for a target of around 192.
Thank you very much for that. Let's turn our attention then to commodities. Manisha is here with us. Manisha.
Nima, thank you so much for that. I'm looking at the crude oil prices because while we did see some profit taking yesterday in the New York session, we have seen the crude prices rebound back yet again. This is after the US has, for the first time now, sanctioned oil tanker companies which are carrying Russian crude oil, which is above the G7 price cap. Remember, G7 has put a price cap on Russian crude oil prices at $60 a barrel. And we all know that the prices have been trading above that. So while that supply from Russia should have gone down, but we do understand that some of the tankers are still carrying Russian crude oil because that is available at discounted rates to the Asian consumers. So this is the first of its sanctions now coming in for the tanker companies. Apart from that, the support also comes in as OPEC says that the global oil stocks will fall or get into a deficit by 3 million barrels per day in the fourth quarter. That is the current quarter. That is because we are looking at lower supplies coming in from OPEC and allies. But when you look at the US numbers, well, those are clearly on the bearish side. You have the production, which is now at a record 13.2 million barrels per day. Earlier record has been at 13.1, which was in March 2022. Also, when you look at 2020 rather, also when you look at the inventories in US, well, those have been surging higher as well. We've seen previous weeks see an inventory surge of 10 million barrels. So now we stand at a 424 million barrels into the US markets there. So that is what is keeping the prices in check here. Having said that, Russia says that the current oil prices have factored in the West Asia conflict. So we are pretty much in the prices there. Also, when you look at the support coming in for prices, that comes in from gasoline inventories in US, which have continued to decline, telling you that the demand there is on the positive side. So we have seen 1.3 million barrels of an inventory decline for gasoline. Same has been the case for distillates as well. Also watch out for the demand forecast for this year and the next as well. So while we talk about this year, IEA and OPEC are on same page, barely a 0.1 million barrel per day of a difference. It is the next year that there is a big gap between IEA and OPEC expectations of global demand growth. So while OPEC is quite bullish at 2.25, IEA believes that it is going to be less than a million barrel per day of a demand growth. So this is a number that we will see perhaps correcting in the days to come. Having said that, the expectation is that you could be looking at some support continuing for the crude prices. For this week now, we are up by nearly 2% for the crude.
Thank you very much for that. Some more stocks which, come up on our radar. Zaggle reported the Q1 numbers yesterday. Didn't look too good, but today the stock has surged close to about 12.5%. BGR Energy won an order a little more than 100 crore rupees. So that stock has surged close to about 7.5%. And Angel One, very strong Q2 numbers, and stock has surged 5%. RITES and IRCON are the other two stocks on our radar. Vivek joins in for more. Vivek.
Well, good morning. That's right. So both of the railway PSU stocks are in focus, both RITES as well as IRCON. So what's actually happened is that, both of these companies, which are under the Ministry of Railways, the government has gone ahead and upgraded their status to a Navratna status. So what this basically means is that, all of the CPSE, the public sector enterprises that are, financially viable and have got a certain amount of financial performance that they have displayed over a period of time, get this particular upgradation of their status, which means they have increased financial independence to go ahead and actively compete for orders and also go ahead and actively make a larger financial decision making up to 1,000 crore. So now what happens is that these companies can invest up to 1,000 crores independently without the central government approval that they required earlier. What does IRCON do? IRCON is number one, the infra construction space across roads, highways, bridges. All of them come under the Ministry of Railways, remember. And RITES offers transportation infrastructure connectivity consultancy as well as railway inspection rolling stocks. So both of the stocks under the Ministry of Railways, increased financial independence and also increased borrowing limits is something that augurs quite well for them.
Thank you very much for that. HDFC AMC reported numbers yesterday during market hours. Looked like a good set of numbers, ticking all the boxes. Upasna joins in for details. Upasna.
Well, HDFC AMC is a stock that remains in focus today on back of its Q2 FY24 numbers. In terms of revenue, we are seeing seeing an uptick of almost 12% on quarter-on-quarter basis. Quarterly average AUM has also seen an uptick of 8% on quarter-on-quarter basis, and revenue yields have expanded from 47.3 basis points to 49.02 basis points. Well, now talking about the quarterly average AUM contribution of equity, that has also gone up from 21.2% to 23.8%. Now talking about the brokerages, Morgan Stanley has given an equal weight with a target price of 2,375. It believes that the strong equity markets are driving robust revenue for the company. However, structural yield pressures will likely to continue. HSBC has also given a hold rating with a target price of 2,580, and they say that the moderation in income yield will lead to slower earnings growth. Jefferies has given a buy ratings with a target price of 3,250. They say that the earning estimates have been raised by 3 to 4% to factor stronger equity AUM growth. CLSA has given an underperform rating with a target price of 2,770, and they say that the AUM growth of 4% sequentially, along with the improvement in the yields, will support the revenue growth, is what they have said. So all in all, we are seeing a positive commentary coming in from brokerages on HDFC AMC on the back of its Q2 FY24 numbers.
Okay, good all-round performance. Upasna, thank you very much for that. So now today, if you look at the large caps, the top Nifty gainer is HCL Tech, up 2.5%, and the top Nifty loser is Infosys, down close to about 3%. Both the companies cut their FY24 guidance, yet the performance in the stock is so very divergent. So the question is why, when both of them have cut the guidance? Well, the answer is that the outlook for the next half of the year, for which is where the companies have maximum visibility, nothing beyond that. Now, the reason why Infosys cut the guidance is because their second half of the year is going to be very muted. According to the implied growth given, if you have to meet the guidance, growth is going to be negative. The company needs to do 0 to minus 2% if they have to achieve their guidance, which means the cut in guidance is because of a muted second half, a weak second half. HCL Tech cut its guidance because the worst appears to be behind the company. It's the weakness in the first half of the year because of which the company cut the guidance. The outlook for the second half of the year is very promising. If the company has to meet its guidance, the revised lower guidance, they need to do about 3 to 4% in Q3 and in Q4. So that's the big difference. It's the forward-looking outlook for HCL Tech, which appears to be far more promising compared to that of Infi. Infi will degrow, but HCL Tech will go up 3 to 4% in Q3 and Q4. So which is why you're seeing that big difference in the stock price, despite both of them cutting their guidance. Also, a quick word, both the companies did well on margins, beating street expectations, and both the companies reported record high deal wins. We'll slip into a very short break on that note. On the other side, we turn full macro. September inflation has fallen to 5%. How does this change things on the policy front for bond markets? Lata will chat with Upasna Bharadwaj of Kotak Bank and Abhishek Upadhyay of ISEC PD.